It's kind of the reverse of a partnership or a REIT where you're raising the money to go buy the property.
Right.
The DST, we already own the property and we're paying ourselves back. We're backfilling the capital into the property.
Are you ready to transform your life? This is a no-nonsense show helping immigrants like you create generational wealth, even while working full-time. Get ready to take notes. Here's your host, Saket Jain.
Welcome back, my Great to Wealth listeners. Today we have the pleasure to talk to my good friend Ray DeWitt. Ray, how are you? Ray, did I say your last name correctly? I always forget.
DeWitt.
DeWitt. I like that.
Yeah.
Awesome. Hey, thank you again for being on the show, man. Appreciate it.
Yeah. Thanks for having me. I'm glad to be here.
Awesome. Ray, where are you located?
I'm in Salt Lake City, Utah.
I'm actually going to be there next week for the BEC.
Yeah.
The Best Ever Conference. Are you there?
Yeah, I'll be sponsoring a booth.
Oh, perfect. I'll stop by.
Yeah.
That'd be awesome. That'll always be awesome. So, Ray, thank you again for taking the time. I know you're a busy person, so we'll jump right into it. So, the name of our show is Migrate to Wealth. As I keep reminding our listeners, the most important piece is migrate, not really wealth. Wealth is going to come if the migration is intentional, right? So with that context, help us understand what your migration journey has been to kind of like what got you into doing what you do.
My migration journey?
Yeah.
Meaning how I got to where I am, why I
Exactly. Pretty much. Yeah.
Okay. I've been in the financial services industry now for 25 years. I've got all those different securities, insurance, real estate licenses, lots of continuing education every year. My background was, your traditional financial planner peddling mutual funds and annuities to people, and kind of had an epiphany about 10 years ago that all my biggest, wealthiest clients, all their money was either in their business or in real estate. They weren't buying mutual funds or stock portfolios and making millions off of that, and I learned about this whole world of securitized real estate, syndicated real estate, and the light bulb kind of went on, and I thought, wow, this makes a lot more sense. And I had left my position at a bank. It was very successful, one of the top, one of the largest banks in the country, and I got sick of the bank. I left and started my own kind of little firm. And I think I kind of had a midlife crisis where, why would somebody work with me versus Chase or Wells or Ryan, just this guy? But I started learning about these real estate products. So one day a guy from England brought donuts into my office to talk to me about the Delaware Statutory Trusts in 1031s.
Wait, where were you at that point, Ray? Did you already leave the bank or you were still with the bank?
I left. I quit the bank.
Okay. And where is this guy from England? Did you know him? Like, why did he come to your office?
Inland is Inland's actually the fifth largest real estate company in the country. They're privately held. And they actually invented the Delaware Statutory Trust. And they're the largest manufacturer and sponsor of them. And so one of their sales reps dropped in on me to talk to me about it. I didn't even know what a 1031 exchange was.
Right.
And I didn't know what to think of the product. And the next night at a party, I met some guy talking about how he wanted to sell his real estate, but he didn't want to pay taxes. And the only way to do it was with a 1031 exchange, but he didn't want to own more property. So he's kind of stuck. And I went, oh my gosh, I just learned about this product yesterday called the Delaware Statutory Trust. So I called Brian at Inland back and said, tell me more. And I literally just had this almost overnight epiphany. And I said, this is what I'm going to do. I'm going to, right here in little Salt Lake City, I'm going to kick ass at this and be one of the leaders in the country. And this is what I'm going to do. And I started learning about, 1031 exchange ins and outs and more about the real estate process. And here I am in 2023, literally one of the perennial top 10 producer, the leading firm in the nation for Delaware Statutory Trust sales. And
good for you, man. Good. Congratulations. I said congratulations for your success.
Yeah, thanks. I love that. I'm not just trying to sell financial products to people. I'm actually helping them solve tax problems.
So let's dig deeper into that, right? So I'm not going to assume we've had different conversations about 1031 before, but let me just kind of set the stage what 1031s are, and then we'll transition to what DST is, Delaware Statutory Trust, right? So 1031, for those of you who don't understand, is really a tax code where you can take an investment real estate and exchange it for another investment real estate. It has to be investment. And in that transaction, whatever capital gains you had in the first transaction, you can roll those capital gains in the second transaction and really defer your taxes. Right? So you're basically using the amount of money you would have paid for taxes to basically put back into the investments and for it to continue growing. Just like a 401k or an IRA, that's exactly what you do. You're not paying taxes today. You're basically let your money grow tax-free. And then at the end of it, when you take it out, you're going to have to pay taxes. Same thing in there. Now, there are other ways to kind of eventually figure out a mechanism you may be able to avoid taxes, but chances are you'll have to be dead for that. So we won't discuss that here for now. So that's really what 1031 is, right? It's called like exchange property. So you're exchanging one investment real estate for another investment real estate to defer the taxes. So Ray, you had mentioned that you were trying to learn about 1031s, and then the Delaware Statutory Trust came your way. Help us connect the dots, the two different terms. How do you combine the two together?
Yeah. So to clarify, we'll call it a DST for short. Sometimes people get confused. I just want to clarify this. There's another DST out there called a deferred sales trust, and that is a very different animal. Yeah. So the Delaware Statutory Trust, DST, is the only syndication eligible for a 1031 exchange. The IRS has formally blessed it as eligible, and literally what it is it looks like a partnership or real estate investment trust from 10,000 feet in the air, but there's some very distinct differences. The reason people love the DST is you're tired of the tenants, the toilets, and the terrible teas. You don't want to fix crap anymore. You're sick of the phone calls, the leaky faucets, the air conditioning going out. So what the DST does, it helps you take the terrible teas and turn it into what I call the wonderful teas, and that's the tea time, tequila, and travel.
Love those.
And gets rid of your landlording headaches. And often people, they want to cash in the property, they want to sell it, but they're going to pay $1 million in taxes. And man, that really sucks. It also hurts your earning power on your potential cash flow and everything. So enter the DST is you sell your property. You put your cash at your intermediary, just like you would with any other 1031 exchange, and then the money goes into a DST or a bunch of different DSTs. It's very easy to diversify, and you're 100% passive. You start getting deposits every single month, starting immediately, hands off. And it's typically all very high-end, new, and boring Class A real estate. It's very safe money. We're talking Amazon and industrial buildings, brand new multifamily apartment complexes, Class A in desirable neighborhoods. Yeah. Every asset class, storage, student housing, industrial, medical, every asset class, just like any other real estate. And $100,000 minimum investment. It's a fairly low minimum. I do have to mention, you do have to be an accredited investor to qualify to invest. And if you don't know, accredited investors have $1 million net worth.
Outside of your primary residence.
Yeah, and that's an SEC or a FINRA requirement. So very easy. Let's say you just own the fourplex. You wanted to sell it. You sold it for $1 million. Hypothetically, you could invest into 10 different DSTs. So you could be in all sorts of types of assets all over the country. And the cool thing about the DST, where it's different than a REIT or some partnerships, is you know exactly what you're investing in. So every DST is tied to a set address, or sometimes addresses if it's multiple properties. But as an investor, you know exactly what you're investing in. Yeah. If there's financing on the property, you know exactly the financing terms, which I'll segue what's another superpower, so to speak, of the DST is the ability to replace debt. So oftentimes as institutional professional investors, we use debt, 40 to 50% loan to value to buy these properties. DSTs are using all the same strategies you would use when you're buying property, but the debt to you as an investor is non-recourse. It's not on your name. You don't have to do a loan app. It's just when you buy in to share units of the trust, you're getting the encumbered real estate along with the equity. And what's really cool is the IRS says that counts. So if you sold your property for $2 million, you had $1 million mortgage, right? And it's in 31, you've got to buy $2 million real estate, right?
Correct.
But you only got $1 million to do it with. So how do you do it? You go get a loan on the next property. Well, that's a pain in the butt for, especially if you're tired of the toilets, tenants, and trash, you're certainly tired of mortgages and stuff,
Yeah.
right? So by buying into, in my example, the 2 million and 1 million, let's say you buy into a 50% loan to value DST, you put your million in, you're getting 2 million in real estate. And the IRS says, you're done. 1031, you're good to go.
Got it.
So it's fantastic. It can allow you to get new depreciation. Sometimes you can't get financing, or do you want to get investment financing right now, 7.5%? I sure don't.
Yeah.
DST solves a lot of problems. It's also great for boot in a transaction. You sold your $1 million property, you found something for 800 grand that you love. What do you do with 200 grand? You pay taxes on it.
Yeah.
Or you put it into the DST.
Got it.
They also make great backup plans. If you think your deal may fall through, name some Delaware Statutory Trusts as backup plans, because these are deals that are already in place and you're literally just investing into a funded.
Yeah.
It's the appraisal's done, the environmental, the inspection, right? The lending, everything's in place and you're just buying.
Actually, I'm going to slow you down a little bit there. I think you're going at an amazing speed for folks who understand it all. So I'm going to dumb it down, if that's okay. And you correct me if I'm saying something incorrect, right? So what happens at 1031, because that's a premise. We make sure that the premise is very well understood. So premise is, we were talking about what is 1031. A 1031 exchange is you're exchanging your capital gain on one investment real estate and you're rolling it into another investment real estate. Now you can do it multiple different ways. So one way is you go find your own deal, right? That's one way. The second is you find a syndication, which is essentially somebody else is a sponsor and they're taking the headache of tenant toilets and termites. And then you're investing alongside of them. Okay, that's perfect. So these are two ways. But there's third ways. There are other ways too, but those are two that we're going to be focusing on today. So now the second way gets bifurcated. If it's possible for me, we've already isolated the problem that you actually hated running the property by yourself, right? Because otherwise you can always go that direction. The second is the one we're really going to talk about, because that's where the DST, the one that Ray specializes in, Delaware Statutory Trust, is what we're going to talk about. So if you're going to put the money into syndication, why do you need a DST, right? So let's think through that for a second. The money you need, if you want to roll your money, a 1031 money, into a syndication and you want to do it yourself, the way to do that is your company or your individual name has to be on the title for the next property you own, right? That's the way to do a 1031 exchange. If you don't hold the title in the new company, the IRS will not consider it as a 1031 and the taxes will be due. So most of the syndications require $2 to $3 to $5 million of minimum investment in a 1031 to basically bring you in as a 1031 person. Most of us may not have that kind of capital gains. So then what do you do? So in that case, that is the market. Now, even for $2 to $5 million, even that the DST is definitely suitable for. But what Ray just told you, if you sold a single family portfolio you have one single family rental and you sold it and you basically have a capital gain of 100K, you cannot take that typically, a syndicator will not accept that money and give you a 1031, won't honor a 1031 because it's too much work to put your name on the title. But a DST that Ray specializes in, that is a vehicle. You can put that 100K into a syndication, because that's exactly what Ray's the front end to. The DST is a front end to a bunch of syndications where he has pre-selected for you a menu of options, not just one. You go in, you're like, I like this, I like this, I like that. I want my 100K to go into this, this, and that. Ray, did I say it correctly or did I mischaracterize anything?
I'm sorry, repeat the question.
Did I say it correctly or I said something incorrectly?
No, it was good.
All right, perfect. I like when I say it correctly. So now what we're talking about is, right, so what we're saying is it's really a passive investment vehicle for you to collect mailbox money on. And when I'm coming to you for a DST, for 100K, what does that process look like? Do you show me, is it there one DST bucket? And if that bucket has 5 properties underneath of it, and when I'm coming into that bucket, I'm investing in all 5? Or you have multiple DSTs, DST1, DST2, DST3, and then I'm coming into, I have a choice of picking either bucket. Help us understand what that process looks like.
Right. So every let's just assume majority of DSTs are one property. So every DST is its own entity. It's got
Okay.
its own tax ID. It's got its own, some of them are multiple property. There's some stuff out there, but most of it, like I said, the addresses. You're investing in Main Street luxury apartments, right?
Sure.
I don't know. So we call the Main Street Luxury Apartment DST, and you're investing in that property. That DST, we're raising $50 million or $100 million. And once we raise that money, that DST is closed. There's no new investors. And we're operating the property.
So you're not collecting a pool of money.
It's kind of the reverse of a partnership or a REIT where you're raising the money to go buy the property.
Right.
The DST, we already own the property and we're paying ourselves back. We're backfilling the capital into the property, if that makes sense. So this is stabilized, it's leased out, it's rented out, it's up and running, being managed, and you're just investing and hopping right in and off we go. Raising rent, operating property, doing everything you can to make money, right? So what the process is like is I obviously, what do you need? Do you have a debt replacement need? We figure that out. So I show you the DSTs that have leverage instead of the ones that don't. I literally kind of show you a menu at a restaurant, say, hey, here's 40, literally right now, I think I have 40 offerings available, 40 different individual DSTs that you could choose from. I do not work for any of those companies. I do not manufacture any of these. I'm purely a broker. I'm a fiduciary. My fiduciary responsibility is to help educate you as an investor and do the right thing. And I'm literally going to just show you a list of the properties we've approved and say, hey, here's this great apartment in Florida. You say, I don't want to invest in Florida for whatever reason. Okay, great. We'll never talk about Florida again.
Yeah.
Let's look at Texas or Arizona. Or do you want industrial? Do you want storage? What kind of property do you want? I, of course, will help you. I've got my favorites, my opinions. But my broker-dealer, which is Concord Investment Services out of Detroit, we specialize in the DSTs as a firm. And we actually have our own due diligence department that literally researches all these sponsors. We vet them to make sure they return capital. Can their principals pass a background check? We look at everything about these companies. Before we bring them on, we make them get an independent due diligence report. We make them get an independent letter from an attorney stating that this actually is structured as a DST, because there's got to be very specific language or the IRS is going to avoid it, and everybody's going to not want that, right? So we do a lot of research before they even these companies make it to our menu. So we don't work with every DST on the market. Sure. 2 reasons. The most common reasons we wouldn't work with somebody is we don't think they're good, or maybe they're just too new. Go practice on someone else before you invest with our client. We do everything we can to protect the customer. At the end of the day, I want you to sleep at night. So, we're going to make this as educational and easy as possible to do. And it's really simple. We do all the paperwork, everything's digital nowadays, everything's DocuSign. We then reach out to your intermediary and accommodate the wire. And then, boom, if you were to invest, I don't know, it's the 27th. So you invest today, you could get, 1 day of rent on your March check. And then in April, you would get the full March payment, right? So it starts quickly. Yeah.
So Ray, I could be wrong, so I'm going to say something, and if I'm wrong, correct me. I consider DST as you have an agreement with the syndicator of saying we're putting this DST vehicle together or an entity together, and that entity is going to bring a certain amount of money into the deal. And because of that, they would bring you in as a 1031, right? So if you're doing that, is there a risk that you may not be able to raise the capital that you had committed with a syndicator? So is there any risk of that happening, so that when I roll my money into your DST, what are the guarantees that DST is actually going to close?
So the deal's already done.
Okay.
So I go and I buy the property. I buy this, an Amazon distribution warehouse. Okay. Sure. I go out and I'm leasing it to Amazon, and I take that trust and I take that, and then I have it owned by the Delaware Statutory Trust that was created just for that property.
Got it.
So I've already bought it either with my own capital. Oftentimes they'll use a bridge loan to buy the property. And then as they raise the capital, I either pay myself back or I pay off that bridge loan, depending upon how the property is purchased. So the property is pretty much purchased. And part of our due diligence is do they actually, does the DST actually own this property?
Yeah.
We do a little bit of a title search kind of, is this a real deal? Right? So it's in place. That's the great thing about it is, unlike trying to buy a real property where sometimes weird things happen with either the financing or the environmental or who knows, sometimes things just don't go through on sales. I think anyone who's ever tried to buy real estate can tell you the DST has done all that crap's been taken care of. So as an investor, boom, you're in. You walk away. It's really that simplified for the investor. It takes, there's a lot of work on the front end for the DST company putting the deal together. And then once it's together, it's totally hire and forget for an investor.
And Ray, how is your company or you getting compensated in this structure, right? Kind of like who is paying you? If I'm rolling money into 1031, is it coming from there? Is it coming from asset management fee? Is it coming from, how are you getting paid in this transaction?
So, great question. Next one, please. No, I'm just kidding. I get paid a commission. So all the commissions, all the reserves, taxes, escrow, closing costs, everything built kind of baked in to the DST. So they're there. I'm getting a commission. So for example, when we go back to this Amazon building, I bought it for $100 million. Okay. When I put it in the DST, I'm syndicated it at $110 million, just to make the numbers easy. Okay. So that extra $10 million is covering all those costs, my commission, tax reserves for the property maintenance, whatever closing costs, marketing expenses, it's all there. Yeah. But so if you invest $1 million into a DST, you're literally buying $1 million worth of units. So $100 million, your million, you literally just bought 1% of the property. Sure. You are entitled to 1% of all proceeds. So if I tell you you're going to get a 5% cash flow and you put it $1 million, you're going to actually see $50,000. And on the back end, when they sell the properties, they don't get their disposition fee if they don't return that minimum $1 million back to you. The costs are really baked into the deal. They're there. You're not going to see all these commissions on.
So you're seeing it's basically like a syndication, right? So instead of going to the syndicator directly, for 1031 purposes, they're coming to you, correct?
Yep. And that leads me to, speaking of, I brought up reserves and maintenance. Like I said, these are typical newer properties, like oftentimes built within the last couple of years.
Sure.
So there's not deferred maintenance. There's no capital calls allowed. Yeah. We can't substantially improve the property. We can't call everybody and say we need 20 grand for a pool. Right. The deal's done. The deal is set in stone. Even the financing is set in stone. You can't do a cash out refi. You can't even refi the debt barring financial catastrophe. There's like a protector to protect the investors barring some weird event like COVID. So it's all set in stone. So if they sell the property, they have to return the capital back to you. Got it. The trust dissolves. They can't go buy something different. It breaks all the rules of the DST. The IRS has set all these stringent rules up, and we have to follow those rules for it to work. And in my opinion, this is the most transparent syndicated investment vehicle. You got the SEC regulated it, and you got the IRS regulated it. Both of those scare the hell out of me. It's a great program. They typically will sell the property. Since they can't refinance the debt, and most commercial debt's got a 10-year balloon, they're selling it before 10 years. 5 to 7 is the average hold lifespan.
So what happens in the event they sell it? So let's say, I got $1 million into deal. That was my capital gain from 1031. I rolled into a DST, and that $1 million now became $2 million. Hopefully more than that, but let's just keep the math simple. So now I have $2 million of capital gain, one from the previous and one from the new deal. What happens when the DST is closed?
Okay, so the DST company is going to notify you well before the sale. Hey, we're selling. Here's the expected close date. What do you want to do with the money? Do you want us to send you a check, or do you want us to do another 1031 exchange? Who's your intermediary?
Got it.
A lot of people, once they go into DSTs, they kind of tend to like it.
Keep rolling it in. Yeah.
Drop, as we say, right? But you don't have to. You could take that money and go buy a car wash, right? Sure. You could buy a fourplex. You can do whatever you want in another 1031. You're not stuck in a DST forever.
Got it. And with me investing in a DST, are there any other fees that I'm paying?
Any other what?
Any other additional fees that I'm paying to you or your company beyond just investing the money with you? No.
In the DST, so the distributions are obviously net of, there's a cost to manage property.
Yeah.
But I will tell you this is 99.9% of the time, the property manager fees in a DST are a lot less than what you're paying. They're paying 3% of the rent. The typical property managers are paying 8 to 10% of the rent.
Yeah.
We're dealing with large billion-dollar national-based real estate companies.
Correct.
This is not, you and I putting together a fourplex somewhere. This is pretty legitimate, big-time institutional quality real estate. From a tax standpoint, very tax-friendly. There's no K-1s. The technical term is called a grantor letter, but it's really more like a consolidated operating statement. So they will send you the statement. One half of it shows the overall deal, the overall property, and then they break out, well, you own 2.5% of the property, so your share, and minus the expenses, here's your deductible stuff. It's an operating statement, and you file it under Schedule E. And CPAs love it because they just get it, and you're not figuring out your receipts for your maintenance. Right? It's just, boom, here it is, file my taxes. And oftentimes the income, as we know, investing in real estate, you get a lot of tax advantage income. The DST does all the same stuff. Some of them do cost segregation analysis that will pass through to you in the way of tax-free income for several years, or, depreciate everything you would try to do to write off your real estate investments. The DST is doing that and passing it through to you.
So let me ask one question to you, Ray. So let's say we have a scenario where we have a syndicator. We'll call us syndicator X, right? That syndicator X, I have an option to take my $2 million. We'll take that as a number again, $2 million, and going directly to syndicator X to do a 1031. And this syndicator is okay investing, using that money. Or I have an option to going through you from a DST to come to them with a 1031. What are the advantages of me going through you, or disadvantages going through you versus going directly to that person? Is there a change in the distributions? Is there a change in the fees? What am I losing out on one path versus another?
Why would you go around me, basically? Why not?
Why not?
Typically, you'd be surprised at how many referrals I get from the DST sponsors of people trying to do it themselves. They kind of make work with a financial intermediary. There are some firms out there that market direct to the public via online marketing. I'm not going to name names, but we refuse to do business with any of them, and it's because we've researched and vetted them. So it's not true of every firm, obviously, but if you're not working with someone like me and you're going direct to the company, who's providing research? How do you know their deal is real? You have to do all your own research. Are they showing you other deals? No, they're showing you their one deal. I've got to look. So you actually won't really, I mentioned Inland earlier, you call Inland directly, they're going to turn around and kick you back to me. Say, hey, we'll talk to you all about our deal. We'll talk to you. Here's all the info you want. But if you actually want to do the paperwork, you got to call Ray.
Got it. I think my question was different. My question was also about if the syndicator, if I'm a limited partner in that syndication, let's say I'm getting a 5% cash on cash. If I'm going through you, am I still getting the same cash on cash? Or there's a dip in the cash on cash?
No, it's the same.
It's the same. Perfect.
Yeah.
You're basically, what you're saying is, as an investor, for me, it doesn't matter if I went to the syndicator directly or through you. The only advantage here, the biggest advantage here is you have done the due diligence. I have now a superpower of someone like a Ray and his broker dealer to make sure they have vetted the deal. And I'm not paying any extra. Everything is coming off of the syndicator is paying for that. So we're not paying you. And that was going to be part of the closing cost to begin with.
Yeah, I mean, it makes more sense to work with someone like myself.
Of course.
Because I know what's going on with the deals. I've got the connections. I'm going to show you deals you didn't know exist unless you wanted to just sit there all weekend Googling everything and researching.
No, I know what you mean, man. It's a very closed world, yet very open world. Unless you get in there, it's not open, right? That's how I look at the world of these investment private placements, that you have to know how to get in.
I hire a guy to mow my lawn. I didn't research the best lawnmower,
There you go, man. You don't need to. Yeah, it's mowing the lawn. All right, perfect. Now, I think that makes sense. That makes sense. So if somebody were to do the DST, what are the steps they need to do? They need to contact you. What are the steps? Walk us through.
Yeah, so first and foremost, if you're considering selling and you want to learn more about the DST, obviously call me. My phone number, 801-815-6619.
You're a brave soul. There you go.
Little plug there. Yeah, call me. I'm happy to educate you. It's not a sales pitch. It's an education event. And that I try to educate you on the pros and cons of the product. And, it's deciding, first of all, that you want to go this route. So maybe you haven't listed your property, but you're considering it. And I help commercial brokers get listings all the time because they've got this guy, he's 74 years old and he won't sell because he doesn't want to pay taxes, but he sure hates it. And he sure wants to sell. And they bring me in and I show them the DST, he lists the property. They get the listing. I work with brokers all the time. In fact, I'm actually housed in a commercial brokerage real estate office is where I work every day. Yeah. So the process, you have to contact me. If you're in an exchange now, great. It's really important that it works just like a regular exchange. You still have to let your buyer know you're doing an exchange through the proper real estate addendum. You still have to put your money with a qualified intermediary or 1031 accommodator. If you don't know one, I'm happy to refer you to one, but oftentimes your title company will do it or they have someone they use. It's a very specific type of a title role, right? They're literally holding your money and making sure you do identification, right? You got 45 days, then another 135 after that close. You don't have that problem with the DST. They're going to close. I literally have had people walk into my office at 9 a.m. and be funded by 3 in the afternoon.
Awesome.
It's that easy, the DST. Yeah. So just call me. I've got a website with it. We post executive summaries on our website for people all the time. You can go check it out. We do weekly webinars. We do seminars all over the country. My partners actually wrote a book called Are You Tired of Toilets, Tenants, and Trash? So I'm your guy. I'm the man. DST Ray,
DST Ray. Love it.
Yeah. Ray is spelled DST. So, not RAY, DST. That'd probably help Chad introduce me to you.
Yeah, definitely. I would love that now.
So, contact me. I don't know if we can put up my contact info on the screen.
We will. Yeah, I think we will include the information in the show notes. So anyone who wants to get in touch with you for DST, and I want to say that again, it's not Deferred Sales Trust, because we have an episode on that upcoming as well. I want to make sure they're both DSTs, but they're different DSTs. They're intended, it's a completely different structure. And one is not better than the other. The purpose is very different. So you want to understand both and let both Ray and Brett talk to you about what would work better for your specific scenario. Because Ray's DST will not even work if you have crypto. You can't do a 1031 on a crypto. So that's not for Ray. That's for somebody else.
Yeah, and anywhere in the country, anywhere in the 50 United States. I literally have clients in 25 states. My goal is to get clients in all 50. I know it'll happen sooner or later. So it doesn't matter where you're located. We're doing Zoom right now. We do the same thing. So
awesome. Ray, thank you for that. Ray, we are coming towards the end of the show here. So I do want to ask you two questions that we always ask, right? So in your journey, you have an exciting journey, right? You were in the dark side of Wall Street, and now you're on the bright side of real estate. So how does that, when you reflect back, let's say this way, what would you tell to your 20-year-old self to make their life journey more intentional?
So repeat that last sentence.
What would you tell your 20-year-old self to make their journey in life more intentional of what they want to do? Like if you were to reflect back, of course, you had a very interesting career and a successful one. But what are some of the key, maybe one or two insights that you would share with your 20-year-old self?
Well, going through that now, I got my youngest son's 20. I'm going to University of Houston, go Cougs. And I've been trying to say, hey, get into real estate, sales, start your own business. Don't go work for somebody. He just got offered. He's just started actually last Tuesday at Fidelity customer service to get a Series 7 and do all that stuff. And I just said, it's great. Finish your degree, but don't get stuck at Fidelity. Having a Series 7 is great, but also handcuffs you in a lot of ways. But use it to get into real estate. That's where I think the money is. Real estate. The most money I've ever made in my life is off of real estate.
Off of real estate, yeah.
Off of real estate, do real estate every day.
Awesome. What would be one thing that you think that humanity should migrate towards? What's lacking in humanity right now?
What's the one thing I should migrate to?
humanity, the world as a whole, should migrate towards?
I said, okay.
So what's one thing that world as a whole should migrate towards? What's missing in the world? Kindness, love, connection, whatever the traits that you see missing in general with a lot of people right now.
Something that I'm missing?
Not you, the world is missing.
Oh, treating people you want to be treated.
Yeah.
Be honest. Take care of each other. Give a damn, I guess you could say.
I think give a damn is on that big note. We'll definitely call it quits here, because give a damn is the key important thing. Because if you don't give a damn, life's not worth living. Ray, thank you again for this, man. We will include your contact information in the show notes. I appreciate your time, and thank you again.
Thank you. Yeah, appreciate it. Thanks, sir.
If you got value from this episode, you might consider sharing this content with a friend. But most importantly, be sure to take action on what you've learned. One way you can take the next step is to connect directly with Socket on an investor call. That link is waiting for you in the show notes below.
The content of this podcast is for informational purposes only. Please consult your own advisors when making any investment decisions. Keep listening. We'll see you on the next episode.